Welcome to everyone. I hope you can hear us properly. I'm standing between you and very exciting discussions with my expert colleagues and our distinguished panelists, so I'll only be a few minutes. I'm very happy we have this opportunity to have quite a rational discussion about the role of the digital euro. We'll be discussing who is the digital euro for, why we need it now, how it should be designed, and discuss some of the steps to success. This event also comes on the back of a Finance Watch report authored by my colleague Christian Stiefmüller, who will be speaking during the event. It's a policy brief called The Digital Euro, a Matter of Trust, where you'll be able to find all the arguments that Finance Watch deploys in this debate. Now, I mentioned having a rational debate, and I have an opportunity to tell you why that's important. Just this morning, we saw a group of people from the financial sector, a group chaired by the vice chair of Santander, issuing a report mentioning that there's a risk that the digital euro may prove too successful and introduce a monopoly into the payment industry. You got to be firmly seated to read these sorts of things, or maybe, you can guess the financial sector, the financial lobby sees nothing as too outrageous. But if you do take a step back, we today have a private oligopoly, obviously, of the management of money and of the payment system. And now we have a pretty humble and quite reasonable, as we'll discuss, proposal to reintroduce some element of public interest in that discussion. The minute you even start to discuss that, you have a pushback that all of a sudden, you could have a public monopoly crowding out private actors. Again, I probably can't say the words that run through my mind when I have to read such reports. So and on that front, sort of allow me to say a few basic things. Money is first and foremost a public good, right? It's provided and controlled by the state on behalf of citizens, and this is not an NGO position. This has been a basic consensus for the last 150 years, right? Now, obviously, for a number of reasons, we've sort of moved away from that position, and again, we think digital euro brings back an opportunity for some public interest consideration. So, as you understood, we believe the digital euro is a good thing for Eurozone citizens, and it's key for ensuring that public, i.e. central bank money, remains available to citizens in the digital age. Yes, as we move to electronic payments and forms of payments, whether you like that or not, it is happening. In that context, it's not a nice to have; it's a necessity. We think the EC proposal, on the whole, is balanced. We support it. It does a decent job within the constraints that we all know of the treaties. And so actually we see this as we see that the EU has an opportunity to set a global standard, a sort of precedent, and prove that a currency for the digital age is compatible with European values. And these are democratic control, accountability, privacy and data protection, accessibility, and inclusion. And for that, the proposed hybrid public-private distribution model must have a credible public option. So we need to have citizens' rights to privacy and data protection embedded in the design. And obviously, as we argue in the report, the digital euro also must not become an exclusive domain of the young or the digital natives. Now, after these few words, I will hand the floor, I think, to Christian, who will introduce the first panel. I wish you a very open and constructive discussion. Let's avoid political correctness and go to the heart of the matter, so that we go to the essence of the arguments and see how this project can benefit, again, EU citizens. Thank you very much, and have a nice discussion.
Thank you, Benoit, for your kind words. And for leading us right into the discussion. Before I go into introducing my distinguished panelists, I would just like to share with you the netiquette for this afternoon's discussion. please do make sure you display the full name and organization so that we know who we are speaking to. You can interact with the participants, with the panelists using the Q&A feature only. So please do place your questions on the Q&A tool, and with every question, please indicate again your name and organization so that the panelist who receives it is aware who they are speaking to. Again, please, if you would like to direct your question to a particular panelist, also make a note of that for the benefit of the moderator. And this webinar will be recorded and will be available on our website for future reference. Now, without further ado, I will go right into our first panel. Can I have the previous page, please? So this afternoon, we have the pleasure of having three distinguished experts on this first panel, which is tasked with shedding some light on what the digital euro is supposed to be for and why we're supposed to having it now. I would like to start with Professor Barbara Brandl from the University of Frankfurt, who has been researching global payment systems and the digital euro, and is the author of several very relevant publications. We have Jürgen Scharf, who is an advisor to the European Central Bank and has been advising the ECB on the digital euro project effectively since its very beginning. And we have Gabriel Söderberg, currently with the International Monetary Fund, previously with the Swedish Riksbank, a very experienced and very distinguished expert on and specialist on central bank digital currencies. So good afternoon, and thank you for joining us. So I would like to launch right into this now. The question has been asked time and time again, and is being asked increasingly, with all sorts of arguments being bandied about. Why a digital euro? What is the use case? Why do we need it, and why do we need it now? Since it is a joint project of the European Commission and the European Central Bank, so to say, clearly for the benefit of the European citizen, I would like to ask Jürgen Scharf to perhaps introduce that topic.
Thank you very much, Christian, and also thank you very much to Benoit, who gave a brief introduction where I want to start with. Why digital euro? We have to separate the policy or the macro perspective from the use case and the benefit to a single citizen. And as Benoit already stated in his introductory words, money, the provision of money, and to make sure that payments are available to everyone is a public good. It's important that the public sector takes care that money is provided, payments are possible, and that the integrity of the monetary system and payment system is guaranteed. Now, what we are currently seeing is that all areas of the economy or social life even is going digital. Why would the central bank be the only big player in this context who sticks to a technology that we had already in the 17th century, namely banknotes? So money from the private sector is going digital. Why would the central bank be the only one when everything else goes digital? We need, that is our conviction, to fulfill the promise that even the private monies that we see from commercial bank payment service providers is very comfortable, innovative, and smooth. As the central bank, we need to deliver on the promise that you can convert the private monies into central bank money at any time. So the highest level of security in terms of credit risk, the highest liquidity, and it's an element, it's a glue that keeps the whole other elements together. So in a digital era, we need to make the monetary and payment system future-proof. That is the first step in the reasoning of why we need to come up with a digital version of public money. What we see is that the use of cash is going down and the usage of new forms of private money is increasing. And as it is with all network goods in the digital economy, there's an inbuilt tendency of the creation of monopolies. So we see in electronic payments on the point of sale, we see that very few strong private players are dominating the market. Unfortunately, most of them are non-European. So by origin, we currently don't have a European issuer of a pan-European means of payment that you can use everywhere. We're observing that. We are observing that the traditional universal means of payment, cash, cannot be used in e-commerce. And we are seeing that, at least as an option, it's not off the table, and there have been a couple of attempts that non-money providers, huge big techs with a global outreach, could step into this field from one day to another. Big techs with user bases up in the billions, who could take over the payment systems and dominate this field in an unprecedented way. So that's where we are coming from, to provide a money that is future-proof amid scenarios, some of which we already know that they could materialize, others we don't know. So that's very important when we talk about strategic autonomy, or even more so resilience. This is not targeting any particular provider of modern solutions. There are issues which are already there, but it is about making our monetary and payment system resilient to future developments that we can't even see now. 10 years ago, we were not aware of what consequence we could have been, but we were not, what consequences it can have to rely on sole elements of energy, sole providers of energy, the supply chain in the provision of medication in some fields, and so on and so on and so on. So when we talk about resilience, it's not targeting a particular competitor or a particular country or anything. It's taking care that we can ensure the integrity and the smooth functioning of our payment systems also in the future. Only then, but we can talk about that later, in a hybrid system with the public sector, with the private sector, we of course have to then also see that there is a dedicated benefit to the user. So that's different from the energy supply. It's important, but it's likewise important to realize where we are coming from. And why do we do this now? This endeavor is a big one. And it's not that you can test in a real context. We have to be prepared very well. It will take some years. We have the legislator being involved, and we cannot wait with the preparation until the need to act becomes imminent. Therefore, with this lead time to be prepared for situations we cannot completely foresee, we have to start now already. Thank you very much.
Thank you, Jürgen. I think as you alluded to already, this project, this initiative, takes place in a sort of broader global context. As you were saying, there are big techs out there already sort of trying to enter that space in some way, shape, or form. And clearly, there are also other jurisdictions exploring the field. It would be quite interesting to hear, perhaps from Gabriel, sort of where other jurisdictions stand on this topic, because we hear that more than 100 jurisdictions are exploring central bank digital currencies at the moment. So it would be quite interesting to see where the EU stands and where others are.
Absolutely. I mean, as you say, that more than 100 central banks around the world are exploring CBDC to one to some extent, although the extent that they're doing so, and especially at what depth they do so and how far along in the process they are, that is a very diverse landscape. And in terms of that's the question that you pose in Britain, other major jurisdiction, it's of course, I should say also that, of course, I don't work with on any of these central banks. All my information of these are publicly available. And also, I should say that just because all of these central banks are exploring CBDC doesn't mean that they will issue CBDC. I go back also to what Jürgen just said, that it's also about ensuring, starting a process of exploring, so that if the need arises in the future, you should be able to quickly act rather than then starting the preparation. So I think that's a very important point that I would like to emphasize. And I think that goes also for other major jurisdictions. So again, going back to some of the major jurisdictions, such as China, of course, is very well known in terms of its CBDC project. They began thinking about a digital central bank money already in 2014. They are now conducting a major pilot in several different provinces and cities. The total extent of it is difficult to get exact numbers on, because it varies, because parts of the pilots are sometimes closed down, they're reopened, etc., because they're testing so many different features. The latest numbers we have is that hundreds of millions of app wallets have been downloaded, but of course it's very difficult to know how big are the volumes that are being processed to this. To what extent are people buying real goods and real services with this pilot digital money? So they are progressing. They are testing out many different features, such as offline, various levels of privacy, different methods of acquiring privacy, those sorts of extra features. USA, same thing there. The Federal Reserve published a report, I think early last year, in which they stated the public case and to open a public discussion about risks and opportunities with CBDC. They're also conducting technical experiments, but again, that doesn't mean that they intend to issue a CBDC, only that they are preparing to do so in the overall work stream of preparing for digitalization. And they've also made it clear, Jerome Powell, the Federal Reserve Chairman, made it clear also in a statement to the Congress testimonial that they will not issue a digital dollar unless there's a clear consent from Congress on that. I could mention UK as well. So the Bank of England, together with His Majesty's Treasury, issued a report earlier this year, a consultation paper, again to mark an engagement process with stakeholders, with the public, to start a discussion about a potential digital pound. And they are now going into what they call the design phase, which will last 2 to 3 years, and the earliest possible decision whether to issue or not would be second half of this decade. They have a statement which says that they deem it at this point likely that in the future digital pound will be needed. But again, that doesn't mean that they will intend to do that. And then also, how does the EU compare? You have that question as well here. I think all of these central banks have something in common, which is that they don't rush. They're very careful, very deliberate. They know the potential risks, and they are very careful to get it right. That's the impression I get from moving methodologically and slowly ahead, while being mindful that things can change very rapidly in a digital environment.
Thank you, Gabriel. So plenty of work being done, really. And I think what is interesting too is that obviously this doesn't take sort of place in a vacuum. It takes place in the context of what is already sort of a very well a well-developed national and international, system of payments infrastructures, commingling already today sort of private and public actors. And it would be quite interesting to perhaps shed light on how a central bank digital currency, especially the digital euro, could fit into this sort of ecosystem, so to say, and how it could affect that. And perhaps Barbara, if you could share some thoughts on that, that would be very interesting. Floor is yours.
Thank you very much for your invitation. And I want to emphasize things that already have been said with a slightly different angle, since I'm a social scientist and I'm interested in social inequality and the dynamics attached to that. So when we talk about cash, this is a public infrastructure, and it's the maintenance is a public good, and it's funded publicly. When we talk about cashless payments, we talk about a private infrastructure, and this has always been private, and it already started in the 50s and 60s with the rise of the credit cards. And now we see when cash is on the decline, we see that we exchanged a public infrastructure with a public infrastructure. No, the other way around, a public infrastructure with a private infrastructure. And this has two serious consequences. The first consequence is cash is available to everyone. Everyone, even kids, have access to cash. You cannot exclude someone from the use of cash. Of course, you can have no cash because you didn't earn cash. Yeah, clear. But if you cannot, but you can exclude people if they don't have a bank account, if they don't have a smartphone, and so on and so forth. So you can exclude people from cashless payments, from cash, from money that is only in ledgers. This is the first serious consequence. And as we know, we already have, Jürgen, I think, already mentioned this, that if we exclude people from payments, we exclude them from the society. Because there is no other way that you can shop, that you have access to food, to everything, if you exclude people from cash, from money. So this is the first serious consequence when public infrastructure shifts into a private infrastructure. The second serious consequence is that everything gets more expensive. I think we want to elaborate on the second point, but I want to make this point now. We have traditionally three segments in banking. This is asset management, investments, and payments. And traditionally, payments was the least, it didn't make a lot of benefits within payments. The other sectors were much more lucrative, if you think in investments and asset management. But this shifted in the last years. Now the payment sector is totally on the rise. We see in 10 years, we see a rise of 10% in revenues in the payment industry. But what happened? We have to transform payments into a in order to transform the payment sector, this business area, into something lucrative, you have to transform payments. And how do you do this? You have two angles. The one is, and the most important one is you included credit. So you have the overdraft fees. This is the most important fee within the payment sector. But then you combine a mechanism which is really drives social inequality, which is consumer credit, not credit as such, but consumer credits. It's a big dynamic, and but you have to combine these two in order to be beneficial. And of course, interchange fees, but this doesn't have so much to do with social inequality dynamics. So my point is here, if we only have private infrastructure, we build in an infrastructure that potentially leads to social inequality. And if we have a public infrastructure, these moments can be separated.
Thank you, Barbara. I mean, that is indeed sort of a very pertinent point. I would say, prevalence of private channels, payment channels in the online world, in the mobile world, also sort of affect economics clearly, and they also affect, as I think both Jürgen and Gabriel mentioned earlier on, affect sort of the competitive landscape inside these private inside this private domain. And Jürgen, indeed, I think was already pointing out that, as we all know, in the digital world, there tends to be a very, very strong trend towards winner takes all situations, towards oligopolistic and very concentrated market situations. Now, I think it would be interesting, perhaps. I mean, what I would like to do at this stage is perhaps to give some room to the panelists to perhaps react to things that their fellow panelists have said, and kind of pick up perhaps on one or the other points, if you would like to. Please feel free. Who goes first? Jürgen, please, the floor is yours.
Yeah, I wanted to reiterate a point that Barbara made on financial inclusion, which is sometimes a bit perceived in the context which might be misleading. So in the European Union, and in particular the Euro area, now the issue of financial inclusion is not so strong as it is in developing countries or so. So we have very low figures of completely unbanked. Still, there are some, and the issue is that we have to prevent the phenomenon of financial exclusion in the future based on monopolies or based on hurdles which affect the most vulnerable groups in the society. You can already now, from time to time, experience when you want to pay with a special card, with a particular card somewhere, it's not accepted for whatever reason. And if you cannot pay with cash as a fallback solution, which already today sometimes happen, there is a particular group of people, that's then the people who are not customer of the preferred companies are excluded. But you could think of a development where this is getting stronger, not for the reasons we see in developing countries, but for others. In order to prevent financial exclusion based on market concentration, it will be important to have a publicly offered fallback solution.
Absolutely. Thank you for emphasizing this point, Jürgen. I have a question for Gabriel, or maybe for you both. You mentioned that all the, and we, of course, I follow also this and globally this trend to CBDCs, and why are the central banks so hesitant? What are the main factors for this to develop or to bring it on the market?
Or you say, is your question basically why are central banks so slow? Is that what you're saying?
Yeah.
So I think it is. I mean, I think that's two. I mean, I think there are three things. I mean, one is that the first, I think, most important thing is, as I said, central bankers are by definition careful people, very circumspect people. It's in a way, it's when we see the major, looking at monetary policies, the major experiments has taken place when there's been a crisis and innovation is forced almost. So I think there is, and central banks were very, very careful in doing something that could go wrong, etc. So I think that's the major one, that central banks wants to get this right. And I think this is also why we need to get this right. We need to, if CBDC should be issued, it needs to be done correctly. And I think that's the most important things why things are going, as you said, a little bit slow and methodologically. So to me, I think that's a positive thing. The second thing I think also has to do with there's still ongoing a public conversation about this. It's something new. What's new with it? In a way, it's not new because central bank money for individuals have been around in the form of cash. What is new is that these are digital central bank money. Digital central bank money is not new because banks have them all the time and pay each other in the interbank payment system that central bank operate. So banks like central bank money. Now the question is, should also individuals in the EU case, in euro area, should euro area citizens be able to hold central bank money and pay with that? But still, it's something new because it's digital central bank money for the public, not just for members of the RTGS system. That's the second one. The third, I think, is, which connected to that, as I said, is this public discussion. And we are not there yet in which we have informed people what's this about. We are still talking about it. I say we as a global community, because I see us basically as co-explorers of this new field. We are still engaging in the discussion with stakeholders, with the public, etc. And I think all of us need to become better at talking about these things. What are the stakes? What are the problems? What are the potential solutions of the problems? And then move on from that. So don't be frustrated. It's a process.
Thank you, Gabriel. In the interest of time and actually picking up on what's just been said, I think it will be quite interesting, perhaps, to bounce this question sort of back to Professor Brundle. I mean, I think we've set ourselves the objective to try and figure out sort of what will be the impact of the digital euro, assuming there is a case for it in principle. Sort of what will be the impact, especially on our sort of payments landscape in the EU? So how will it, to pick up on Jürgen Schaaf's point earlier, as well, what will be the benefit actually? How will it change the environment there? I think if I understand you correctly, Professor Brundle, you were saying there, you know, we've created a public sort of for a private infrastructure and cashless payments. So how would you expect the digital euro to address that and to kind of reframe the competitive environment in payments for the better, we all hope, I think.
Thank you, Christian, for this very good question. And I want to say a few sentences before I answer to this. I would argue that we have, when we want to establish a payment infrastructure, we have a trade-off. And a trade-off between, on the one hand, we want to have an inclusive system. So as a policymaker, we want to have an inclusive system that everyone can participate. And on the other hand, in order to be beneficial, or we want to create incentives for private companies to step in. These are two, and these are really contradicting settings. And when we look at the US, so the German, as Jürgen already mentioned, we don't have so much financial, not so much a problem of financial inclusion and in Europe, and the fees are very low. For example, overdraft fees in compared to the US are really low. So we are around 9 to 10%. In the US is 20 to 30%. So the US sector is highly lucrative for private companies. When we look at the revenues per person per year in the US, they earn in average $1,300 per capita per year. And in the US, in Europe, it's quite the opposite. It's around, it differs between the member states, but it's between $300 and $400 per capita per year. So it's only 20%. So the payment industry is making only 20% in the European Union compared to the US. But we have an inclusive system. We have a more inclusive system than the US, but of the cost that we don't have any private company in the European market for that is because it's highly unattractive. So my biggest question, I really like the proposal for the digital euro, and I really think it would be fabulous if we would have it. But I'm highly doubted that it can be realized because or it can be realized without additional funding and public funding for this project. Because for private companies, the payment sector is not really attractive because they don't make a lot of money in Europe. So I very look forward to the second panel where this is discussed within the payment industry. So I really think we would need additional funding to set up an alternative to the already existing payment infrastructures that really can compete with these other options.
Thank you, Barbara. That is indeed a very interesting angle, and I suppose it is one that chimes in with quite a few concerns that generally come from I suppose the private part of the industry, sort of the private industry, starting with clearly on the one hand sort of the payment services providers saying, is this attractive for us? All the way to the banking sector who's posing similar questions, but also posing the question, does this compete with our deposits? Does this basically, is this going to become a risk to the funding base for banks? So I suppose these two questions probably fall squarely into Jürgen's remit in the first place. So I will give you the floor for first, and then move on to Gabriel.
Yeah, thank you very much, Christian. If you ask the question, could a digital euro affect the refinancing role of deposits for banks and as such financial stability? If you just have a look at the technology, the answer would be yes. If you ask the question, will that be the case? The answer is no, for the following reason. We should not confuse the realm of technological possibilities and options with what effectively is being done, because we will have rules, we will have legislation, we will have controls, checks and balances and the like. And our approach will be that we take care by design to avoid these risks to financial stability. For the following reason, there are basically three options how the deposits of a bank could be affected in this context. First case would be a single bank is less attractive, and people would move their funds from the bank A to bank B. Well, basically, this is already now possible. If you have your deposit, it's digital money, digital commercial money, you can move it from bank A to bank B. So there's nothing new about this. Second option is you would have a bank run because of a financial stress environment. People stop having trust in the financial sector, in the banks as such, and then would withdraw their money from the banks at a short period in time. That is, in terms of mitigation, similar to the third case, which is a structural disintermediation. People, customers could find central bank money provided by the ECB more attractive than commercial bank money with their deposits, and over time transfer their funds to the ECB. So we would face an issue of structural disintermediation, leading to more costly approaches for banks to refinance themselves when they provide credit to the private sector. Now, for the last two cases, we have foreseen that we will have sort of caps for the money people can hold with a digital euro. Important here is holding limits are different from payment limits. So the deposit function of the digital euro will not be its key function. The payment function will be its key. The deposit function is the one that banks fear, and we will say we will cap this function so that the structural or short-term outflow is not attractive. In this respect, when we're talking about the order of magnitude, sometimes you hear this figure of 3,000, which is not cast in stone. This we did in order to make it more tangible to digest. Where does it come from? We have, in the first reflections, checked how much money in terms of banknotes is circulating in the euro area or maybe outside, which is quite easy to do because we know about each and every single 5 euros banknote that is circulating. This is in our balance sheet on the liability side. We don't know who has the money, but we know that it's out there. So this amount divided by the number of citizens in the euro area ended up in the order of magnitude of 3,000 euros. So that's something we could compare. We had other calculations checking how much outflow on a macro level the banks could weather in case you would see this disintermediation funds flowing from the banks to the ECB. And we calculated that this would be a maximum that the banks could weather was 1.5 trillion, which is similarly, if you divide it by the citizens in the euro area, comes up with a similar amount. So in this respect, this maximum figure, 3,000 per citizen or 1.5 trillion, is a maximum. It's not very likely that everybody who has access to a digital euro will transfer all his or her commercial bank money to the ECB, and in particular not transfer all the money to the maximum amount. So if we are talking about this maximum figure, you have to take this as a mitigation calculation in order to check the limits to err on the cautious side. So if you divide the amount by 2, and if you divide the number of people who would probably do it by 2, you're ending up with a much more realistic figure. So we have technically foreseen a cap on the holdings to prevent an immediate and a structural outflow from the banks to avoid financial stability issues. And the figures that we are currently discussing, they are not set in stone, they are not defined yet. That will become a discussion closer to issuance. That comes later, but we are quite certain that we can prevent such an financial stability outflow.
Thank you, Jürgen. I think sort of these twin problems that, we've, I think, sort of put our fingers on right here. So the question of how to ensure that the necessary infrastructure is put in place, and how to ensure that, the private players already sort of having access or having invested in infrastructure are, incentivized and cooperating to make that infrastructure usable on the one hand, and then on the other hand, as Jürgen was just saying, the question of financial stability, the risk of deposit outflows. These are all things that clearly sort of are germane to the central bank currency as a concept. So I think every jurisdiction who considers it will, in some way, shape, or form, be confronted with that. So perhaps best the question back to you, Gabriel. How do you see that in a broader context? How are the jurisdictions addressing it?
I mean, absolutely. I think Jürgen painted the panorama, highlighted all the potential risks and discussed them in an excellent way. I mean, certainly this is a very important question. It's a question that all central banks who are exploring CBDC needs to take into account and be prepared for. The IMF is now developing a handbook on CBDC, subsequently publishing chapters on exploring CBDC, how to do that. We started earlier in September, published the first 5 papers that will later be developed into chapters of the CBDC handbook. And one of the chapters will absolutely be about financial stability implications of CBDC potential. And how do you mitigate those potential risks? Because absolutely, one of the key issues when exploring CBDC is having a clear picture of all the risks involved and how do you mitigate them. And Jürgen also discussed potential ways to do that, holding caps, zero interest rates, etc. So I think that we need to see also this in a dynamic context. And I also think we need to understand that the economy and the payment system is always changing already without CBDC. We already see that flows of money goes much quicker now than previously. We saw the recent examples of bank runs, digital bank runs on individual banks. It doesn't go into cash, it doesn't go into CBDC because there is no CBDC, but it's equally easy to move into bigger banks usually. Flight to safety can also be just move money from a smaller bank into a bigger bank. So I think we need to see this in a bigger context of a changing environment. And is there a role for CBDC within this changing landscape? And the intention with that is, of course, to see, is CBDC something that can contribute to this overall financial stability domestically and in the international monetary system? And I think this is also what central banks are exploring now, and also what the IMF is exploring with the so-called CBDC handbook. Because if CBDC should be issued, it has to be done in the right way. And that is methodologically systematic and going forward while also looking at all the risks. And this is one of the risks, certainly.
Thank you, Gabriel. I think we've got a lot of questions, actually. It strikes me that the Q&A channel is already very, very lively. And it is quite tricky to see where we can start, because there are very, 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 very different questions on different angles. I suppose one very interesting one to start with is that we've got a question here that refers to the public narrative that public money is the safest money. Where does that leave commercial bank money? Does the ECB really want to insinuate that commercial bank money is not safe? So since it talks about the ECB, I suppose this is one for Jürgen.
Thank you very much. Yes, this is a tricky one, of course. I mean, if you state that central bank money is safer than commercial bank money, it's just a fact. This is not an attempt to criticize the stability or safety of the private sector or the banks. It's not the case. It's just a fact. The narrative why you need a digital euro in that context comes from the observation that people know this fact. Some know it consciously, others don't. But there are occasions when people want to convert their very safe private money from the banks into traditional safest asset that there is, cash. For whatever reason, that's just the case. And this promise that you can convert commercial bank money, for whatever reason, is something that the public sector, the central bank, needs to deliver on. So we have to take this into account. The option to convert into central bank money gives you an element of stability, but it also fulfills the other functions of money, like unit of account. If you have only isolated islands of private monies, it could occur that you at one point get exchange rates, implicit or explicit, between private monies. If you have this anchor of central bank money that is available also for retail payments, this also takes care that the unit of account with this stays and is available. So this element of stability has become so traditional, so accepted, that people from a normal citizen, from a layman to an expert, that it's not reflected anymore sometimes. So it's taken as a given, and it's our job that people don't need to care about it indeed in the future, but we have to take care that it works.
Thank you, Gabriel. Sorry, Jürgen. I've got one question here, I think, which sort of digs a little deeper into your the point you made about the role of public and private infrastructures, payment infrastructures, and how the predominance of private payment infrastructures and the role of consumer credit associated with payment services drives inequality. I think so. The question basically is sort of, could you further explain the effect of the form of infrastructure on consumer credit and therefore inequality? Perhaps could you sort of briefly sort of recap this argument? Thank you.
Yeah, I try to do this. So as I said, we have three branches of banking. And they work very differently. So when we look at asset management and investment, there we have not so many transactions but high value, and it's risky. On the other hand, payments work very differently. We have a lot of transaction, but it's not very risky. But we have this, I've already mentioned, it's an infrastructure which tends to be to a natural monopoly. And because we have this different, because we have this setup, and infrastructure is only under certain conditions you can provide it as a private player. And my argument was basically, in order to make payments beneficial, you have to transform payments. And one of the major transformation was to link it with credit, to link it with credit. And it's a certain type of credit, it's consumer credit. And we know from the sociology of credits that credit work very differently. For example, if you have a house, a credit for a house or something like that, this is very beneficial for higher classes or for people with high incomes. They all have credits and they work for them. They have good conditions, good conditions for their credits. But consumer credits have traditionally very bad conditions. So the interest is high. You have to pay back very early on, and this is not. It's not created by the payment system. It's created by the consumer credit. And in the US, just to mention it, so the overdraft fees are around 20%, and for bad credit, it's 30%. So it's really, really high. And now we have this dynamics. It's independent from the payment system. It's the dynamics of consumer credit. But now we have a system, the private infrastructure systematically links consumer credits with payments. And you have to use your payment infrastructure every day. So you have this link, and you don't. Sometimes you even don't know. Do you pay, or do you have a credit? It links it together. So in this way, it forces the social dynamics of inequality with from consumer credit. And this problem is there, but not as high as in the United States and Europe, because the overdraft fees are not really high now. But I just want to say there is an incentive to rise to rise overdraft fees, because it's the most important way of gaining money in the payment sector are overdraft fees. So I just want to point on this dynamic for social inequality.
Great, thank you, Barbara. I hope this has answered the lingering questions of our audience, and I'm still making my way through the very many questions here. But I have one at the very top, and I suppose it is one that has been, percolating through this discussion all along. It's directed at Gabriel in this case, but I think it is one that clearly everybody on the panel will, have a view on, and I think would sort of go straight to the nub of the whole discussion. At a level perhaps sort of even more abstract than what the digital euro per se means. We've got here, we were talking about financial stability. We've got a question from the audience, whether financial stability would not perhaps be best served if deposits sort of were free to actually alternate between the commercial and the central banking sector. So if there were sort of actually the possibility for the depositor to go to bring their deposits back to the central bank to save public money in the event of a crisis, and basically sort of de-risk the system in this way. I hope I have accurately paraphrased the question. Perhaps a few words on that, and perhaps also sort of putting it in the broader context, what this would mean not only clearly for the European banking system, but on a broader scale.
So, if I understand the question correctly, it's could CBDC and ensuring the convertibility into central bank money actually increase financial stability and improve financial stability? That's basically how I understand that question. And I think, again, Jürgen mentioned that part of the reason why we trust commercial bank money is that we can possibly convert it into something that is, if we should start to doubt a particular bank, we can always convert it into something else. But it's a two-edged sword, of course, and which is, of course, that if people start to doubt the banks, they will lose too much deposits, even if there's no cause for those doubts. So one thing that I'm thinking about, I haven't developed it yet systematically, is that if people had a buffer of money, basically, be it in cash, I think we should always remember that cash should always be available as well. No one is saying that CBDC should replace cash. It should be a complement to existing cash. If people have a buffer of that, would that make them more prone to feel safe? So they know that they have lots of the bulk of their money with a commercial bank. That money is protected by deposit insurance guarantee. They know that they have enough to get by for at least a foreseeable future, at least a week or so. So they know that they are fairly secure. It's like having like a portfolio of their money. They have one basket of very, very liquid, very, very safe money. And then they have something that could potentially be protected by deposit insurance guarantee, but there might take some time before they can get that money out. So I think, yes, if we take that approach, I think that there could be a case to explore, could that actually be in connection to, as a complement to, deposit insurance guarantee of commercial bank money? Then I think that CBDC and deposit insurance guarantee could actually complement each other quite nicely. Of course, I haven't gone into the full analysis of that, but at least I see a case for that to be explored.
Thank you, Gabriel.
Can I add?
And yes, by all means, please, Jürgen.
Yeah, so in case of the digital euro, the approach clearly addresses the payment function of money. So the store of value function, if you distinguish two elements there, it's that it keeps its value. That's the role of monetary policy. So with the traditional means of interest rates and the like, we try to keep inflation in check and guarantee the purchasing power of money, but it's not supposed to become an investment. That's different. And the role of value storage is in the context of avoiding inflation, which will be taken care of in the traditional monetary policy. So the focus is on payments and not on the deposit function that you need to bridge a bit of time. And it's definitely also not in our remit. So even if we would like to, it's not our role. It would exceed our competence to discuss the strengths and the weaknesses of the banking sector in the economy of the euro area. This is what it is. So this is a variable that is not up to discussion for us. So within these given variables, we want to provide something that is future-proof and fit for purpose in the digital area when it comes to payments. That's what I actually wanted to add.
Thank you. I would like to take that opportunity, because we're coming up towards the end of our allocated time, and there are so many questions still out there. I think there is one that is quite interesting, and I'd like to open up for all members of the panel. It basically asks about the scaling of payment systems and the risk associated with it. This member of the audience asks, what is your opinion about the risky scaling of the payment systems at the European or even global level versus the need of more decentralized and regional ledgers or instruments? Would you like to, who would like to have a go at this suggestion? So clearly, this is about whether there is a room, or whether there's actually sort of I suppose a strong case for complementary currencies, smaller units than the national, in fact, supranational level that we are now considering.
So is this a question about local currencies, or what is that the question? Or
this is how I understand it, sort of whether there is actually whether there is a role here for more decentralized payment systems, and when and how could they come alongside, or would it actually be, what would be your view? Because clearly the proposal of a multinational, supranational currency, digitizing it, creating a single infrastructure, is fraught with challenges. We talked about that. How would you see sort of the role of these other instruments alongside it?
Well, I mean, we connecting it directly to CBDC. I think there are small jurisdictions in which the national currency is covering a very small area. there are some which are very big. And I think I don't necessarily see contradiction between both of these things. I mean, we know that, in a way, we know that the global system is becoming more and more connected. We know that global payments, cross-border payments, are becoming more and more important. So we do see that there is an increasing need to connect different currencies and ensure that that cross-border payments are improved. And we are looking into various ways as a global community to do that, and also ensure that there is not an increased fragmentation of global payment systems. So, I mean, again, we need to both see that we need, to some degree, platforms, networks that will connect, while also allowing for domestic, more regional approaches, but to do so within a context of increasing integration. And how to do that, how to strike all the balances, that is a challenge that the global community is battling with today, and trying to come to understanding of how to do this in the best way, how to strike the balance between the regional, the more regional and the global, and how to strike that balance. So I think this is a discussion that will be very intense in the coming years.
I want to add one point emphasizing what you just said, Gabriel, and that is we already have a very, so when we look at Master and Visa cards, so we have a oligopoly that it spans through the whole world, except of Asia or some countries in Asia. So the digital euro is a project which really contradicts, or which is really against this, and so we already have when you say it's not a small project, but it's another project which is against this oligopoly. So I don't really understand this question, because we have really a different thing going on here.
Thank you, Barbara. I'm afraid we're at the end of our allocated time already, and we're still not even halfway through the audience questions. So I hope that our second panel will sort of still have lots of engagement from the audience, and we'll be able to sort of address some more coming up soon. All I can say is thank you very much for participating. A big thanks to the panelists, a big thanks to the audience, and we are now going to have a very short break before we launch into the second round. Thank you so much.